I'm Owen Bigland. This is the Inside Edge video blog. Okay, this one's going to be entitled Why I Rarely Sell. Whether that's real estate, which I rarely sell, or saving for retirement, investing in the stock market, which I almost never sell. Which I'm going to tell you about in a minute. I've talked to you guys about why you always want to be in the market. You just buy good quality Vancouver real estate, buy your principal residence, enjoy it, sit on your hands, and you're going to do incredible. And it's especially true in the stock market, saving for retirement, putting your money away into your RRSP and your TFSA. Hopefully you're just index investing that I've always stressed that you guys should be doing. It's the only way. Everything else, trading stocks, for the most part, is a complete fool's errand. But, you know, I've talked about buying or selling real estate personally from my own perspective here. And, you know, there's nothing wrong with selling real estate. There's lots of good reasons to sell real estate, usually principal residence real estate. So I've sold three principal residences in my lifetime, and I've owned, of course, real estate for over 35 years, so not all that frequently. The last home I sold was about 7 years ago. Went from a large detached house to a condo here in downtown Vancouver. But there's lots of good reasons to sell. You want to move up, you need a bigger house, you want to downsize. Of course, there's a lot of negative reasons to have to sell, unfortunately, with real estate. I see it all the time. Divorce, job loss, disability, maybe a job transfer, that kind of thing. So there's lots of good reasons to sell. I've always told you guys that if you're going to sell a piece of real estate, if it's your principal residence, hey, and hopefully you've had it for a while, the capital gains are all tax-free. Hopefully you're buying back in. You're either buying a better, bigger and better home, or maybe you're downsizing depending on your needs. But always be in the market. The worst mistake people can make, as I've talked about lots of times on this blog, is when guys try to get cute, as I call it. They want to sell their principal residence because they think the market's going to go down and take a 20% correction. We're going to sell the house, cash out, rent for a few years, and then buy back in. Dumbest thing anyone can do. It seldom works out. Go back and watch the many blogs I've done over the last 10 years on that dumb idea. But there's lots of reasons to sell. Investment units, I almost never sell. I have sold a few in the last 35 years, a few. It's usually, though, to consolidate into buying something else or buying multiple units, taking the cash, which might be, you know, quite a large capital gain, and being able to buy two more units with that money. But, you know, there are other reasons. I've told you guys last year, I think I sold about 7 condos last year that were investor sellers. I have one client over the last couple of years who owned a very large portfolio. I've sold 6 units of his over the last 2 years. We sold the last of them last spring. And the reason for that was he had owned these condos, these units for many, many years, 10, 12, 15, one townhouse he had owned for over 20 years. So had an incredible amount of capital gain. He was getting older. It was just the right time for him. He just wanted to lighten his load, his financial load, was going to travel a lot more. That's a good reason to sell. You never, though, want to sell when just because you think the market is going to take a correction. I'm going to sell, sidestep it, and then buy back in at a better price. Terrible idea. So, and the other thing I tell you guys with real estate, why you don't want to be selling very often, if you can avoid it, is the friction cost with real estate. Extremely expensive. It's not like selling 100 shares of TD Bank. Real estate is incredibly expensive to buy. You've got the PTT, property transfer tax, which is the biggest tax grab going. You potentially have GST if it's new, and a set of conveyancing costs. To sell, you're going to have my real estate commissions, plus another set of conveyancing costs, and if it's an investment unit, capital gains tax. So keep your trading into real estate to a minimum. In the stock market, investing, whether it's for my RRSP or my TFSA, I never touch that. I can't even tell you the last time I've ever sold anything in an RRSP or my TFSA. There's no reason for me to sell. Most of it is in index funds. The only time I've sold recently, in the last couple of years, I trimmed a little bit of Apple. It was in my RRSP only because it had gone up 1,000%. It had become so unwieldingly high a percentage of my holdings that I trimmed a couple hundred shares, didn't have to pay any capital gains tax because it was in my RRSP, and parlayed it into some other things. I also sold in a cash account a few years ago some Eli Lilly, which again, it was a good reason. It had gone up 800%. Needed to trim a little bit of it, and that's what I did. But other than that, I don't sell anything. And you should not be selling playing around with your RSP or TFSA or even your cash accounts. Buy and hold is the only way to go. You always want to be in the market. I saw this dumb commercial on TV. I think it's for TD, which I'm a client of. It was, getting investing your money through TD Online, TD discount brokerage, which I also use. It's good, great discount brokerage, but the premise of it is all wrong. It's got the guy buy and then sell, buys. That's not what investing is all about. There's buying, but there's no selling. If you buy the right companies, first off, most of you, and I'm going to get into a book here, and I'm going to do a review on this. How many times have I pounded home? And the more I read as an investor, I've been an investor in the stock market for 30 years, 20 years as a very, very studious investor. I read hundreds of books. I love it. I enjoy real estate, investing in the stock market, and working out are my three passions. And I spent a lot of time, thousands and thousands of hours, probably in excess of 10,000 hours as an investor over the last 20 years. Hundreds of books to try and become a better investor. The more I learn, the more I realize that I've been imparting onto you guys. Forget about buying individual stocks for most of you, unless you really love it and want to maybe have a small fund or a mad money fund and buy some individual stock, especially if they're going to be some stock that maybe gives you a little higher yield, like a Canadian bank or a Bell Canada. That's why I still hold those names, because I've built a big enough portfolio. They're paying me a 5-6% dividend. It's nice to have those cash flows coming in, and eventually I'm going to live off those cash flows, those quarterly dividends. But for most of you, just index invest. The more I read, the more years I spend trying to become a better investor, the more it goes back to just a simple approach. And I'm currently reading, I'm going to give you guys a book review on this later this spring. Winning the Loser's Game by Charles Ellis. This book has been on my radar for a long time. It was written in the early 1990s, and they've revised it a couple of times. You guys should pick this up on Amazon. I bought that for used, I think, $12. It will solidify what I've told you guys, that do not start picking stocks unless your first 300,000-400,000, and I think all of your RSP and TFSA should just be in index funds. And I'll do another blog on this down later in the spring. Just keep it simple, low-cost index funds. You're not going to pay more than 6 to 10 basis points. You will beat 90% of the professional money managers who talk a big talk on TV. You will blow them out of the water over 5, 10, 15, 20-year periods. Every year, 10% of them get lucky, these money managers, and end up beating the S&P 500 or the TSX, but they won't do it consistently. And the real eye-opener on this book, I've already known all that, and I've told you guys about this. The real eye-opener is that the days of guys being able to beat the market are getting more and more difficult. The market is very different, stock market, than it was in the 70s, 80s, 90s, and early 2000s. With the advent of the internet, and the fact that 90% of all the stock traded on the NASDAQ, New York Stock Exchange, TSX, 90% of the transactions are large professional institutional traders. Banks, hedge funds, private equity. They're all trying to beat each other. It's a zero-sum game, and this book goes on to say that it's so sophisticated now that trying to outsmart the other 90%, which are professional traders as well, with all their resources, it's an arms race. It's getting slimmer and slimmer. So don't try it. Just buy the index. And that's been around for a long time, but this book even says it's even more prominent. It's getting worse for individual money managers. They're not going to beat the index, so don't even waste your time. But I want to close just with, out of this book, just a couple of little things on why I'm always in the market. Because the stock market goes in some incredible rips in very short periods of time, where it'll go up 20 or 30%, and then it'll drop 20 or 30% in very short periods of time. It goes in these sharp ups and downs. Don't try and time it. You're not. How many books have I told you guys? Warren Buffett, Jack Bogle, Winning the Loser's Game will tell you the same thing. It's definitive proof that you're not going to front run these corrections and get in and get out. It won't happen for you. So here's an incredible stat that's in this book here that I want to point out to you guys. So The compound returns of the S&P 500 from 1982 to 1997, okay? So it's a 15-year window here. If you just kept your money in the S&P 500 for the last 15 years, you would get an annual return of 19.6% over the last 15 years. This is between, again, 82 and 97, but you can just project this all the same. This book only went to 97. If you take out the 10 best days, just the 10 best days out of the last 15, that return goes down to 16%. If you take out the 20 best days over the next 15 years, return goes down to 13.8%. If you take out just the best 30 days out of the 15 years, which is 5,500 days, 5,500 trading days, and you remove the best 30, it goes from almost a 20% return down to an 11.9% return. So just by missing the 30 best days in the next 15 years, you're going to cut your returns in half if you just would have stayed in the market. Give you one more stat here. It's incredible. This one is $1 invested in the S&P 500 from 1928 through until 1997. So 69 years. 69 years. If you put $1 in and just reinvested it, let it run for 69 years, that would compound to $1,130 in 69 years. If you took out just the best year, 1 year, which was 1933, out of those 69, it would take your return down to 733. If you took out the 2 best years out of the 69, it would reduce your return down to 482. And just the 3 best years, if you remove the 3 best years out of close to 7 decades, it would take your return from 1,130 down to 327. You lose 2/3 of your return. I know it sounds crazy, but that's the way it is. And that's that. Remember, I keep telling you guys about that PBS Frontline documentary that won all those awards 10 years ago, The Retirement Gamble. You can see it on YouTube. It talks about this exact same thing on why you want to be in the market and you want to stay in the market. And it's end of story. There's no debate about this. I'm giving you guys why I keep pounding this home. Stop listening to these financial experts on the news telling you to buy this and sell this. It's all a giant con, as this book goes into detail on, plus the dozens of other books. I've already known about this. I already know this from my friends, some of my friends on Wall Street 15 years ago who told me it was all a big joke. Everyone just chasing their tails trying to beat the market. They told me, Owen, just put your money in the S&P 500, the VTI, the VIG, the TSX 60, the Triple Q, and call it a day. I still own some individual stock, although in the coming years I'm going to whittle that down to a really small holding. As I get older and getting ready to get into retirement, eventually I just want it all in indexes. But I'll probably still keep some Apple, some Johnson & Johnson, a bit of Pepsi. I love the Canadian banks and Bell Canada for that juicy yield they give me. You know, I'm generating just from my Canadian dividends alone $60,000, $70,000 a year, and it's safe. They keep growing it. That's a nice cushion to have, so I'll keep those. But I've told you guys over the last 10 years or so, 50 cents of every dollar I save goes into the indexes. Last year was probably more like 75 cents. I have not, other than Netflix, which I bought last year because it was just too cheap, I have not added any new names to my portfolio for a long time. I just top up what I currently hold because I don't want the portfolio to get any more names in there. And if anything in the coming years, I'm going to define it even more to just some core holdings. The rest will be in a basket of low-cost ETFs through Vanguard. Most of my stuff's in Vanguard or iShares. Last little thing here. I'm doing this blog. It's February the 1st. Probably won't post this for maybe till next Saturday or the Saturday after that. Sometimes I've got a delay. I shoot some here when I'm in my office and bank a few of them. But let's just take a look at, this is why you always want to be in the market here. It's February 1st, 2023. I just took a look at my portfolio here. Back in November, I was traveling and I actually was in a hotel and I had some CNBC on there and some Fox Business, which I don't pay any attention to, but hey, I was in a hotel, I was watching a little bit of it. You know, the markets were in the doldrums. Back then, I remember Meta was completely beaten up. the old Facebook. It sold off the metaverse. They had pumped billions into it. It's not paying off. The advertising revenue's down. I own Meta. I don't own a huge portion of it, but it's been a core holding for me for a long time. I've done well on it, but I certainly sold off big time here. But, you know, everyone was saying sell Meta. It was all doom and gloom. We're going to have 5 or 6 more rate hikes, heading for a brutal recession. What a difference 90 days makes here. So let me give you some numbers here. Meta. Lowly old Meta. Have you guys seen what it's done here in the last 90 days? Well, it's up 50% since early November. And as I speak, they had their earnings today after hours. I just took a quick look. They beat across the board. It's up another 17% after hours. Now, I don't know how that'll play out tomorrow. Could be even higher. So we're talking now close to 70% increase in Meta in the last 90 days. 70%, 67 to be exact. This is why you don't panic and sell these high quality names when they're down. As a matter of fact, top up and buy some. If you go back into my Twitter feed, you'll see I was buying a little bit of Meta in those doldrum prices. I could care less if it went down another 10 or 15%. I figured they'll right the ship. They've got tons of cash, and they'll get things together here. Take a look at a few others here. Estee Lauder, another incredible company. I talk about it in my book. Owned it for, 15 years or so. Up 40% in the last 90 days. Starbucks up 18%. Visa up 20%. The Triple Q, just the basket of 100 mostly tech names, up 20%. Netflix up 25%. Netflix is one. I bought that last summer. After that huge earnings miss they had. I'm up, since I bought it last summer, I'm up about 65-70% on Netflix. I wish I would have bought more, but that's what buying good quality names, especially when they're on sale and hanging on to them. If you miss those 60-70 days there in a year, you can miss out on 30-40%. In other words, all your big returns happen in very short periods of time. And it's why you always want to be in the market. You always want to be in the market in real estate for sure. Renting is not an option. But there are good reasons to sell your principal residence, as I said, or even sometimes investment units. For me, I've got a pretty large investment real estate portfolio. I'm not interested in selling right now. I'm killing the goose that lays the golden eggs and those fat rent checks I'm getting. In the investments in the stock market, saving for retirement, I almost never sell. And you guys shouldn't either. You should just buy an index, hang on to it, and just keep adding to it, reinvesting the dividends every quarter. Call it a day. But I'm going to do a blog later this spring on this book that'll put the final nail in the coffin and blow it up on why most people should not even be buying individual stocks. Just buy the index. You will blow away all these professional money managers. It's a giant facade that these guys are running that'll tell you that give me your money, I'll charge you 1.5%, but I'm gonna beat the market, outsmart the market. They're not. Why do you think that on BNN Bloomberg, why do you think these guys that talk a big talk there, why do you think they never reveal what the returns have been in their managed funds, what they've been managing their portfolios at? Give us your 1 year, your 5 year, and your 10-year return, and then let's compare it to the S&P 500. Or let's compare it to the Dow, or the Triple Q, or the TSX 60. They never will reveal that to you because they're falling behind it. They're getting their heads handed to them. They might get lucky one of those years out of the 10, but they're after your fees and your commissions, they're falling woefully behind. So don't play that game. And anyone that tells you that, they always will say the same thing. It's different now. It's a stock picker's market now. Those guys on CNBC love to say that all the time, these money managers. They'll never reveal what their returns are because they're dismal. They're getting crushed by the indexes. But it's always, it's different now. You need to have a stock picker doing it. It's a giant lie, folks. So I know I pound the table on this. The one thing you guys get from me here, other than my real estate advice and frontline stories here, is to save for retirement and just index invest through Vanguard and iShares and call it a day. And spend all that time researching stocks and trading and trying to buy and sell and outsmart the market. You're not going to do it. Even the professionals, the best of the best, can only beat it about 10 or 15% of the time. You have no hope. I'm Owen Bigland, As always, thanks for watching. I'll see you next week.